Hi bankers, hearty welcome to the digital platform of IBS, Indian Institute of Banking Studies, one of the leading institutes in the country, which gives training to the bankers for making them efficient bankers. In this video, I'll be explaining about the basic concepts of foreign exchange, which is very useful for those who are preparing for the CAIIB examination. Before moving on to the concept, let me explain what is meant by foreign exchange. See, foreign exchange refers to the exchange of one currency to another currency. So here in this world, the nations are pushing forward for economic growth and greater inflow and outflow of fund. This foreign exchange has become an integral part of the economic scenario, economic sector of any country. So let us move on to the definition of foreign exchange. Section 2V of FEMA, Foreign Exchange Management Act 1999, which defines the foreign exchange as any instrument or a deposit receipt or a check or a bill of exchange or a currency note which is payable outside a country is foreign exchange. As far as India is concerned, any draft payable outside India, say payable in UK or payable in Germany, or a check payable in US, it is foreign exchange. Similarly, any foreign currency note which is payable outside India, or any instrument like a letter of credit or bill of exchange drawn by a bank in Indian rupee, which is payable outside India, is also foreign exchange. Therefore, the process of converting one currency to another currency is known as foreign exchange. Because every country has got a currency, and that currency is called the home currency or domestic currency of that country. Look at India, our domestic currency or home currency is Indian rupee. And for all other countries, Indian rupee is a foreign currency. So for us, Indian rupee is domestic currency or home currency. For an American, Indian rupee is a foreign currency. Similarly, in US dollar is the domestic currency of that country. And as an Indian, this US dollar is a foreign exchange. Now, we'll move on to the features of foreign exchange market. When I use the word market, it means it's a place where you can buy or sell something. So similarly, foreign exchange is a market where the foreign exchange is being traded. But here this market has got some specific features or characteristics, because the first important characteristic of foreign exchange market is it's a 24-hour market. 24-hour market refers to this market is working or it is live around the clock. Because this market, the participants or the players are in various countries. And you must be knowing the different countries are located at different time zones. So because of this, see now in India, let us assume it is say 10 o'clock in the morning. Some of the countries are behind us and some of the countries are ahead of us. So therefore, this market never sleeps. At any point of time, when we close our bank by 5 o'clock, some other part of the globe or in the world, it will be actively participating in this market, buying and selling this foreign exchange. That's the meaning of it's a 24-hour market. Next is, this is the settlement is affected by the time zone factor. Time zone factor, I told you, the different countries are located at different time zones. See, 10 o'clock in India, look at another country, say Singapore. Singapore, they are ahead of us. Australia, they are ahead of us. Japan, they are ahead of us. So by 2.5 hours, Singapore or Hong Kong, they are ahead of us. So at 10 o'clock in the morning, here, it will be 12:30 in Singapore or in Hong Kong. It will be 1:30 in Japan. It will be around 2:30 or 3 o'clock in Australia. So these are all the countries which are ahead of us. Now look at other side. Some of the countries in the world, they are behind us. See, some of the Gulf countries, say Dubai and Abu Dhabi, UAE and other countries, they are behind us by 1.5 hours. And some other countries, say Kuwait or Saudi Arabia, they are behind us by 2.5 hours. So 10 o'clock in Indian time, 10 o'clock, it will be 8:30 in Dubai or in Muscat, and it will be 7:30 in Saudi Arabia or Qatar. And if you move further, the European countries or UK, they are behind us by 3.5 hours to 4.5 hours. Because there, when they move from summer to winter or move from winter to summer, the clock is adjusted by 1 hour. That's what sometimes I use between 3:30 and 4:30. So the 3.5 to 4.5. And in US, the difference will be, they are behind us by 9.5 to 10.5 hours. So here 10 o'clock in the morning, it will be around 11:30 midnight of yesterday. If today is Monday, it will be 11:30 on Sunday night. So this is the structure, and therefore the people, depending upon the two parties in a transaction, because in any transaction there will be two parties, one will be a buyer, another will be a seller. So one of the parties, say the buyer is in India, the seller may be in US. Therefore, these two people are located at two countries, two places which are in two different time zones. Therefore, most of the transactions, Forex transactions, it is affected by the time zone factor. That means the settlement. Settlement refers to the completion or the exchange of currencies is taking, there will be a lag. It cannot happen simultaneously or instantaneously. That's the meaning of the settlement is affected by time zone factor. And the third feature is, it is an OTC market. OTC refers to over-the-counter market. So over-the-counter market means, see, the buyer and seller, they can directly deal, a contact, and they can come into a contract. There is no middleman, there is no exchange in between. And mostly now in this world where the telecommunication has been developed so much, people sitting in Mumbai, he can communicate and enter into a contract with a person sitting in Japan, in Tokyo or in New York, because they are connected with the internet. So if it is connected with the internet, you have a system connected to internet, you can communicate, you can enter into a contract. And this is an OTC market where there is no middleman is involved. Over the counter market. Next is, it is global market with no barriers. That means this market, there is no specific location. If you want to buy some vegetable or fruit, you have to go to a place, there is a specific place where you have to go and get the commodity. But this is not the case with the foreign exchange. The entire world is the area of operation. You can have the transaction by sitting at your office or at your home, and therefore it is a global market with no barriers. Next feature is, it's a highly liquid market. What is the meaning of liquidity? Liquidity refers to the fastness with which one asset can be converted into cash. Let us say, assume you have a deposit receipt. It's an asset. And if you want to convert, you get cash. In no time, you go to the bank, you can close it and you'll get the money. Let us assume you have some gold, 10 sovereigns of gold. In no time, you can go to the gold merchant, you can sell it, you'll get the money. But this is not the case with, suppose you have a flat or you have a landed property, a real estate. If you want to convert into cash, it takes some time. This is an illiquid asset because it takes some time. You have to advertise or you have to find out a prospective buyer and negotiate and then go for a deal. And it takes some time, maybe 1 month, 2 months, 3 months, like that. So here, this foreign exchange market, it is a highly liquid market. That means liquidity is too much. Suppose you have dollar, you have GBP, or you have some other foreign currency, and you want to convert Indian rupee, in no time you can exchange it. That's the meaning of this market is highly liquid market. And the next feature is the flow is huge. There are two ways that the flows happens. One for trade and miscellaneous items, another for investment or capital. So the capital flows, and this flow, it's in two ways. Inflow is there and outflow is there. Inflow means we get foreign exchange. As far as we are concerned, if foreign exchange is coming to India, it is an inflow of foreign exchange. Now similarly, outflow of foreign exchange means foreign exchange is going out of India. So huge flow of foreign exchange is taking place. And this, apart from this capital flow, the another item is the trade flow. Trade flow means it is export trade and import trade, international trade. In export, the goods goes out and we get foreign currency, foreign exchange. And in import, goods comes to India and we have to pay foreign exchange. So in these two items, that means either something connected with international trade or miscellaneous remittances, or it's for investment, the flow or the quantity, the volume is huge. The volume is huge means you just imagine how much will be the volume that is taking place in a single day. As per the 2020 estimate, the total volume of transaction per day is more than 6.6 trillion US dollar or 6,600 trillion US dollar. It's a huge amount. And the next is the fluctuation in exchange rate is high. High fluctuation. Because every 4 seconds the rate changes. The exchange rate is not static. At some point of time, at 10 o'clock, if you look at the rate, mostly the rates are available in two screens. One is the Bloomberg screen, another is the Reuters screen. So in the screen, let us assume at a particular point of time, the value of dollar is say 85 rupees. So you take the pen, you wanted to note down what's the rate. So you note down it's 85 rupees. By the time, after noting down, if you again look at, the rate might have changed. The rate, sometimes it may be 10 paise or 5 paise up. It from 85, it moves to 85.10. Or sometimes it may be less by 5 paise. So it may be, instead of 85, it may be 84 rupees 95 paise. That is what the fluctuation is huge. Every 4 seconds, estimate says every 4 seconds, the rate changes. And another feature is, another characteristic is, the market. This market is affected by government policies and control. Because the government of a particular country, they intervene. If there is a violent fluctuation or variation in the exchange rate for that particular currency, the government intervene and they wanted to stabilize the rate. So government control also affect the exchange rate. We'll move on to the market participants. Who are all the actual players in the foreign exchange market? See, if you look at the first and important player in the market is the central bank of that country. As far as India is concerned, it is Reserve Bank of India. In US, it is Federal Reserve. Like every country has got the central bank. And that bank is playing an active role in the foreign exchange market to regulate the value of the currency and to reserve adequate foreign exchange reserve. Now, next participant is the commercial bank. The bank which does two types of transaction. They does a Forex transaction on behalf of their customer, their clients. And we normally use the term which is a merchant transaction. And next is they go for trade transaction. Trade transaction refers to the bank buys and sells. They trade in foreign exchange. This transaction they buy $1 million from the market. It is not at the request of the customer. Because the first part is they do a merchant transaction. So a lot of customers, they will be giving foreign exchange to the bank, the exporters or the NRIs, they will be bringing foreign exchange, they will giving to the bank and bank buys it. And there are people who wanted to buy foreign exchange goods from foreign country, means they want to import, or they may require foreign exchange for their education purpose or medical or some other activity. So they will be demanding foreign exchange from the bank. So you have to sell. So here this buying and selling is done. Bank does a buying or selling at the request of the customer. So to satisfy the needs of the customer, bank go to the market, they buy or sell. And thus that transaction we call it's a merchant transaction. The second is a trade transaction. Trade transaction refers to the bank does a trading in the foreign exchange. Then what for it is? It is for making profit. Because the dealers, the people who are dealing in this foreign exchange, they look at the market trend. And if it is in a rising scenario, the rates are moving up, At 10 o'clock when they open the system, the value of dollar say it's at 85. And after some time, it moves to 85.10, then 85.20. So the dealer thinks that the value of dollar is moving up. So what the dealer will do, he expect in hours time or in 2 hours time, it may go to 86. So with this intention, with this assumption, this dealer will buy in bulk. Say $1 million or $10 million they buy. There is no request from the customer from the branch, but the dealer buys it on their own intention and with the objective of making a profit. So they buy 1 million, hold it for some time. When the rate goes to 86, so they might have purchased at 85. So after 2 hours, when the rate moves to 86, they sell it, they get 1 rupee per dollar as profit. So for an volume of 1 million US dollar, the bank gets a profit of 1 million Indian rupee. So such transaction also a bank does. So bank does two different types of transaction. One is merchant transaction, another is trade transaction, or we use proprietary transaction. And the third participant in the market is the investment bank. In most of the foreign countries, in India it is not that much. There are a group of banks, say Bank of America Securities or Barclays or Citigroup. These banks are expertise in moving capital from one country to another country. So such banks are called the investment banks. They engage in transferring fund from one country. For example, there is a high net worth individual or a corporate in India, say Reliance. They would like to set up a unit, a manufacturing unit or some other investment in US or in UK. So they may be requiring a huge amount of foreign exchange. They want to transfer from India to, say, UK. So here they can engage this investment bank for moving the fund from one country to another country. Next, the corporates, the big companies, Reliance Industries or Barclays, Tata Motors. So these companies, these corporates, they are also actively participating in the market for either for import or for export, something related to their business or for investment. And then the next is the individual high net worth individual or the NRIs who are also participating in the market for either for investment or for making profit, travel, etc. And the last participant in the market is the Forex brokers. Because I told you the participant or in any international transaction, there are two people involved. One person will be in India, another will be in a foreign country. So the foreign country may be Japan. So sometimes this person in India and the counterpart in Japan, they may be knowing each other. They may not require any middleman's role. They can directly communicate. But in certain time, it may not be possible. The buyer and seller may not be knowing each other. They may not be knowing the requirement. So there comes the role of a middleman. And that middleman is called the Forex broker. So this broker, any person cannot act as a broker. It should be accredited by FEDE. That means if anybody wanted to act as a foreign exchange broker, they have to register, they have to apply to FEDE, Foreign Exchange Dealers Association of India, and get a certification or an accreditation. And based on that, after that, these people can act as a Forex broker. We'll move on to the next concept, that is the factors which affect the foreign exchange rate. The exchange rate refers to the rate at which one currency can be converted to another currency, or I can say the value of one currency in terms of another currency. For example, say let us assume the US dollar is equal to, one US dollar is equal to 85 Indian rupee. So 1 USD is equal to 85 Indian rupee means the value of $1 in terms of Indian rupee is 85. Or I can put in another way, 1 US dollar is equal to, say, 1.20 Singapore dollar. That means the value of $1 in terms of Singapore dollar is 1.2. So 1 USD is equal to 1.2 Singapore dollar. This is the concept of foreign exchange rate. So therefore, what are the factors which affect the foreign exchange rate? We can broadly divide the factors into three categories. The first one is the fundamental factors. Number two, the technical factors. And third, the speculative factors. So again, under fundamental factors, that means the factors which affect the exchange rate in a long run. It's not for a short period, it's for a longer period. And the first and important factor is the balance of payment of a country. What is the meaning of balance of payment of a country? Balance of payment refers to the difference between the inflow and outflow of foreign exchange for a particular period in a country. Let us assume in the month of, say, March, in India, we receive 100 million US dollar. So 100 million US dollar, this is the inflow of foreign exchange during a particular month. That means this much foreign exchange we have received. And during the same period, let us assume 80 million US dollar is the outflow. That means this much foreign exchange has gone out of the country. So what's the balance? The difference between these two, it is 20 million US dollar. So this is positive. That means we are comfortable. As far as the BOP is concerned, the balance of payment is concerned, there is a surplus. So that's the meaning of there is a positive inflow. Let us assume instead of this situation, the first it is 100 million inflow and outflow is 150 million. This is inflow and this is outflow. In this situation, the difference is minus 50 million US dollar. Look at this situation. You compare these two situations. The first one, there is a surplus of 20 million US dollar during a particular period. And in the second one, there is a deficiency. That means there is a shortage, there is a shortfall. They have received only 100 million US dollar, but they have to pay 150 million US dollar. That means they have to find out the difference, the 50 million, in some other source by borrowing. And in that case, the value of that currency depreciates. That is what the first one. If there is a deficit in the balance of payment, this leads to depreciation, whereas there is a surplus leads to appreciation of the home currency. Next is the economic growth rate. Higher economic growth rate leads to appreciation of the home currency. How it is possible? When economic growth is there, that means there is a higher economic growth. The production will be more. When the production is more, we export a lot of goods to outside, to other countries. And when export is more, we get foreign exchange. So we receive foreign exchange. All this foreign exchange has to be converted to Indian rupee. So there is a demand for Indian rupee. So Indian rupee becomes stronger or Indian rupee appreciates. The next factor is the fiscal policies. Fiscal policy refers to the taxation policy. The government every year, they announce in the budget a change in the tax. And here, suppose they lower the tax rate. For example, existing rate, corporate tax is say 10%. They lower to 5%. What is the impact for a business person who is investing in India? If the tax is 10%, this means for a profit of 1 lakh rupees, suppose in a fiscal year, a company has made a profit of say 1 lakh rupees, they have to pay 10% as tax. That means they have to pay 10,000 as tax. If the tax rate is 10%. If it is reduced to 5%, they need to pay only 5,000 as income tax. So if there is a the government has lowered the tax rate. This will attract the people for investment in India. So a lot of people will bring money to India, and all these people wanted to invest in India. And say from Japan, Japanese yen will come. From US dollar will come to India. From UK, GBP will come to India. And all this currency has to be converted to Indian rupee. So there is a demand for Indian rupee. Naturally, when there is a demand, the value will move up. So that is what, if the tax is lowered by a government, the currency will appreciate. The value of the currency becomes more. And the next is the monetary policy. You know, the government, Reserve Bank of India, there is a monetary committee, and they announce the monetary policy bi-monthly. Every once in 2 months, they announce the monetary policy. And this monetary policy they announce based on the inflation rate, the money supply, and other factors, interest rate and other things. So this will influence the currency, the value of a currency, money supply, which have an impact on the value of the currency. And next is the interest rate. Interest rate, how it is affecting the value of a currency. If the interest rate is more, for example, interest rate in India at some point of time, let us say the interest rate for 1 year is 6%. And say the government has, or Reserve Bank of India has raised this rate to say 7% for an 1 year deposit. What is the impact? A lot of people will invest. See, the world community which have surplus money, they wanted to invest, they will bring the money to India, because here they are paying, instead of 6, they are paying 7%. So every year, after 1 year investment, 1 lakh becomes, earlier it was 6,000 rupees, they are getting as interest, it becomes 7,000 rupees. So people will invest. Again, so a lot of money will come to India, inflow will be there. So naturally, when inflow is there, there is a demand for the Indian rupee. So the value of Indian rupee appreciates. So if the interest rate is higher, it attracts overseas capital and appreciate the home currency in the short run. Because here it has got 2 effects. When interest is increased, it will affect the borrowing community. Because when interest for the deposit is increased, naturally the interest rate for the advance also will be increased. So the borrowing community, the business community, they may not be able to do the business profitably because they have to pay more interest. So in the short run, it will be increasing, appreciating. But in the long run, what happens? It affects the production and the slowdown in the economy. And naturally, when there is a slowdown in the economy, the currency depreciates. So this is the next one. And look at the last one under the fundamental factors. It is the political issue. Political issue refers to when the government of a country is a stable one. The currency becomes stable or the currency becomes stronger. And if the government is the government is unstable, then the currency becomes cheaper or the currency start depreciating. And the next category, the broad classification, is technical reason. Under technical reason, the government will intervene, or the central bank of a country will intervene if there is a violent movement in the exchange rate. Like look in India, what happened in the recent past, there was a heavy increase, the violent fluctuation in the value of dollar. It started at say 80 rupees, then after some time 81, 82, 83, like that it was increasing. So then Reserve Bank of India will come to the play, and they will bring in from the reserve a huge amount of dollar, and that will be pumped into the market. And as you know, when the supply is more, the value will come down. So similarly, when there is a violent fluctuation or violent movement in the exchange rate, the central bank of that country intervened, and they wanted to stabilize the exchange rate. And that is what the technical reason. Sometimes the government or the central bank intervene, and they will try to stabilize the exchange rate. They wanted to remove the violent movement in the exchange rate. And that is called the technical reason. And the last one, it is the speculative factors. See, there are group of people who are having huge amount with them, and they wanted to make profit from this. So these people we call the speculators. What the speculators will do, they look at the trend, how the currency, a particular currency is behaving in the market. If the rate is moving up, even though these people, they don't want the foreign exchange, they buy in bulk, 1 million or 10 million, they buy and hold it. And they create an artificial shortage in the market. And when the price moves up, they sell it out. So these people are called the speculators. And